Hi, welcome to our podcast for the month of June 2022. We are seeing still the volatility in markets continue. There are certain macro trends shaping up. So we'll kind of decipher into what trends we are seeing, what it means for the economy, and what it means for markets. So last month we saw GDP numbers come out, and we saw India's GDP for last month or last quarter grew at 4.1% versus 5.4% in the October-December quarter. The GDP growth for the fiscal year 2022 stood at 8.7%, which was again lower than the government's estimate of 8.9% growth. What we saw in the data that private consumption was weak for the quarter compared to government spending and investments, which were still robust. And we think that it will continue to support the economy along with exports, which also recorded strong growth. Q4 GDP overall was pretty decent considering the higher base of 5.7%. This year, FY 23-24 GDP growth estimate would be to some extent impacted due to high commodity prices that prevail, but will still stay at a decent growth level of around 6.5-7%. What would drive that growth is largely private capex, government spending, and exports. Of course, on the export front, it will be good to watch of the adverse impact of interest rate increasing and global growth slowdown that we are witnessing right now. If you look at the recent data, there has been positive growth momentum that continues. Index of 8 core industries grew by 8.5% in April versus 4.3% in March. That was largely led by strong coal production and electricity generation. Given the heat waves across, there have been higher electricity utilization, and that is leading to higher production. May energy consumption registered a 22% YOY growth versus just 13% growth in April. So it could be likely largely not sustainable and largely led by the heat waves that we've seen across the country. Even if you look at the very recent data, which is the high frequency data, we have seen improving mobility, and industrial indicators have been mixed. We have seen railway freight improve again because led by larger coal offtake, while energy consumption has remained stable at the end of the month. Vehicle registrations and property registrations have declined a bit. Economically, fundamentals suggest a more stable regime given by the trends that we are seeing. PMI data showcased robustness in growth. If you look at the service sector growth, continued to strengthen in May, with companies reporting the quickest increase in business activity since April 2011, so over the last 10 years. The upturn was also supported by substantial pickup in new business growth as demand continued to recover following the reopening of the economy after COVID lockdowns. So manufacturing PMI also was robust at 54.6 and stable as compared to last month, which was at 54.7. One important trend that we are seeing is the robustness in Gst Collections. It touched 140,000 crores for May, an increase of 44% year on year. Last year, at the same time, it stood at 97,000 crores. It's gone up to 140,000 crores, and we have seen that it stay at higher levels. So that's one thing that is helping the government in terms of cutting duties or spending programs. That's been a helping hand. So if you look at, because of retail inflation surging to an 8-year high, the government has announced a series of measures that includes reduction in excise duty on petrol by 8 rupees or diesel by 6 rupees, along with reduction in customs duty for raw materials of plastics and steel, and an increase in export duty on iron ore and steel intermediaries to kind of ensure that domestic prices remain restricted or controlled. If you look at another trend on the unemployment side, there was CMI India unemployment rate, which kind of remained stable around that 7% mark. Rural employment has been around that 6.3%, while urban unemployment has been inching higher to around 8.6%. So overall, unemployment rate moderated to about 7.1% in May compared to 7.8% in April. So we have seen some uptick, but again, the worry remains around the urban unemployment numbers. On the goods trade deficit, it kind of worsened to about $23 billion in May due to fallen exports. Rising uncertainty and weaker global growth are weighing on exports and will continue to do so in next few months as well. Non-oil export growth fell to 8% in May 22 versus 18% in April 2022. Despite higher than expected oil prices, oil import bill has not surged as much as India likely benefited from discounted Russian oil. So that's a helping hand. Probably our exports, there are estimates that suggest that exports from crude oil imports from Russia have risen to about 15-20% of our total imports versus what used to be around 2% for the last fiscal year. If India is able to maintain the current proportion of Russian oil imports and the discount sustains, then there could be a benefit of about $5 to $10 billion on our overall import bill. Of course, there is risk from stricter sanctions and payment difficulties to the continuance of this import from Russia. So that is one thing that we'll need to watch. On the monsoon, which could also be a determinant of inflation, how it pans out, especially in the agri commodities. The IMD and SkyMed both have forecasted a normal monsoon for India. So that's really good. The southwest monsoon is considered to be the lifeline of India's agri-based economy, as it is likely to brighten the outlook for bumper crop output amid waning inflationary pressures. So that's if we have normal monsoon, that will help the inflation trend to lower. So given the inflation likely to remain high, which is likely to stay elevated close to the 7% for this fiscal year, still it is above the RBI's inflation band of 2 to 6%, and also higher than what will allow growth to kind of function well. The threshold that we've seen for comfortable for India is closer to that 5.5% mark. So we will see, given that RBI may not be able to continue with such negative real rates for much longer without stoking further inflation. We expect RBI to hike rates further. Maybe we could see a 35-40 bips hike in the meeting on June 8th, and there could be further rate hikes. We anticipate that RBI will want to reach the pre-COVID levels pretty soon, which will be around 5.25 mark. So we will see that until then, RBI will continue to hike rates, and thereafter it could take rates to around 5.5-6%, depending on the inflation and growth trajectory. So after reaching that 5.15%, which was a pre-COVID level, RBI may kind of be watchful of more data, and depending on how growth and inflation is panning out, they will take that call on how much to hike. They will be kind of mindful of slowing growth consumption, given that much of the inflation is getting feeded from the supply side issues. So that we'll have to see. But until then, we will see some more rate hikes from the Reserve Bank. FIIs continue to dump Indian equities. If you look at the month of May, they sold around $5.1 billion in equity market and about $0.7 billion in debt. The 8th month, this was the 8th consecutive month of outflows. And if you look at the total outflows over last 8 months in equities, is closer to $27 billion and about $3.3 billion in equity and debt markets. Domestic investors continue to support markets. So that's been a helping hand. So overall, from an equity market standpoint, rising commodity prices may continue to put pressure on margins. It may also, rising inflation could also impact consumer discretionary spend. Companies over a period of time gradually will pass on the price increases and get to normalized margins. Only we suspect that high quality companies will be able to do it faster given the pricing power that they'll have. Given the high inflation, rising rates scenario that we are in, it's not new to India. We have been here before. markets have managed to do well despite rate hikes in early cycles. And especially after the first rate hike, we have seen that markets generally kind of price that in pretty quickly. And thereafter, we have seen a positive tune in equity markets. I mean, till the end of the cycle, you see from the first rate hike, usually we have seen markets kind of adjust to that reality and give positive returns post that. If you look at our portfolios, they have been positioned for an economic revival. We think that positive growth momentum will continue despite the headwinds that we see. And given that kind of economic revival, financials, materials, consumer discretionary, and utilities will be the sectors that may probably be do well. Our portfolios are geared to withstand interest rate volatility, which means that companies have a strong balance sheet, have cash on their books, are less levered. What are the risk factors that one should keep in mind while investing in equities today? Rising inflation and weak state of small and medium enterprises may impact consumer discretionary spend, so that becomes a headwind for revenue growth of companies. Extended war disrupting the supply chain and pushing the commodity prices higher is also, if that continues, that could feed into more inflationary pressures, and also availability of raw materials. Rising commodity prices may dent near-term profitability, but much of it is kind of now getting baked into prices. Given the scenario of interest rates and inflation, equities can remain volatile for some more time, at least over the next 3-6 months. So invest in equities with a longer term horizon, maybe at least a 2, 3, 5, 10-year view. A 10-15-year view is more desirable, because in the long run, we know that India will continue to grow at a sustainable rate of 6.5% real GDP growth, with the inflation of 5.5% on a sustainable basis. Nominally, India will continue to grow at 11-12%. And with that would translate into an intelligent portfolio growing at about with a nominal growth of around 12%, with some efficiencies priced in. Larger companies getting larger is the trend that we have seen. So with that, intelligent portfolio could deliver a reasonable return to meet your financial goals. So given that high interest rates today can impact both valuations and profitability, a portfolio comprising of businesses with reasonable valuations, pricing power, and less leverage will be the best suited in this kind of environment. So invest in equities with a longer term view, and do keep investing in quality companies which are available at a cheaper valuation. So be it a value fund, or be it sustainable companies which are quality again and have that pricing power. So I think the current bout of volatility gives you a good entry point to build your long-term allocation to equities. And I think investors should use this volatility to their advantage to build that long-term allocation with a 10-15-year time horizon in view. So with that, we hope that you will asset allocate at the end of the day, despite equities being at a good point in time, because you don't know where the risks are coming from. So invest within a good asset allocation, and probably the 12-20-80 with 12 months of safe money and rest being split into 20-80 allocation of gold and equity. I think that would help you not only treat to this current scenario, but any risk or opportunities that the futures brings to you. So with that, I wish you happy investing, and thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.